Hey, good afternoon, everybody. Welcome to the webinar today. Thank you for joining me. My name is Julian Klymochko. I'm here to chat about alternative investments, the ultimate portfolio diversifier. So let's get into it, ladies and gents. Take a look at the disclaimer. It tells you everything you need to know regarding forward-looking statements. All right, so let's start off. What exactly is an alternative investment? So what alternative investments are? Basically, category of investments besides the traditional asset classes such as stocks, bonds, and cash. So the goal of alternatives are to provide differentiated risk return streams above and beyond what you get in traditional asset classes, whether it be something that has no correlation, something that has negative correlation, something with a completely different risk-reward dynamic than what you would find with stock indices and bond indices. So alternative assets include a wide swath of various strategies. On the liquid side, you have hedge funds, cryptocurrencies, commodities, and then on the illiquid side, we have asset classes such as private equity, venture capital, infrastructure, and real estate. So why would an investor consider having alternatives in their portfolio? A number of reasons. Number one, for increased versatility, because you're looking for different assets to perform differently in various market environments. There's certain market environments in which stocks do well. There's certain market environments in which bonds do well. And there's even certain market environments in which both stocks and bonds do well or both do poorly. So investors want to be prepared for that. I call it risk management before it's too late. Second reason to consider alternatives, a potential increased returns. And a third reason why people would consider adding alternative investments to their investment portfolio is decreased volatility, lower risk, and a lower drawdown potential, just given the addition of alternative investment strategies with low correlations to investment portfolio, i.e. having a return stream that zigs while traditional asset classes zag. So those are the three main reasons why an investor would consider alternative investment strategies within their asset allocation framework. And why do many investors these days, why are they looking towards alternatives to further diversify their portfolio? I mean, stocks and bonds have performed very well over time in North America. The 60-40 has really killed it and did well last year. Why should investors consider changing that? Well, the market is different than how it was historically. I'm sure everyone knows record low bond yields. I mean, the 10-year at 100 basis points, that's a real hard sell for investors these days. If your return expectation is in line with what the 60-40 has done, kind of in the 7-8% annualized, it's tough to get that with the 10-year yielding just 1%. And globally, we look out there and there's like over 17 trillion of negative yielding bonds. So fixed income having a rough go these days in terms of future potential returns. Then on the equity side, we just went through a pretty violent period of tremendous equity volatility in Q1 2020. The coronavirus pandemic engulfed the world, caused a market panic. We had the fastest equity bear market of all time, peak to trough. We had record equity market volatility with the VIX hitting 85 for the first time ever, exceeding the previous record set in the great financial crisis of 2008. So record low bond yields, record high equity volatility, and super high equity valuations as well as investors looking at and considering adding alternatives to their portfolio. So from a quantitative perspective, they say that the only free lunch in investing is diversification. And it's our view that just holding two assets, stocks and bonds, is not prudent from a risk management perspective. So if we look at the graph on the right, now what the graph on the right shows is The x-axis is number of uncorrelated assets within a portfolio, and then the y-axis measures the portfolio standard deviation, also interpreted as risk or volatility. So I have some examples here, some numbers backing these assumptions. If we add one uncorrelated asset to a one asset portfolio, i.e. go from just stocks to stocks and bonds, this could reduce risk by 29%. If we further diversify and utilize 6 uncorrelated assets, we could reduce risk within a portfolio by nearly 60%, 60%. So it's significant. And we find the sweet spot is really in that 6 uncorrelated asset portfolio, not the traditional 2 asset portfolio of stocks and bonds. Now let's talk about investor expectations. There's a recent study that came out saying that they polled investors, individual investors, and their expectations for forward returns over the next 5 years is nearly 11%. That's right, 10.9% annualized over the next 5 years. Meanwhile, forecasts on street analysts, they're calling for the 60-40 portfolio to return 2.8% annually in the future. So there's a massive divergence between what investment professionals and analysts, economists expect to produce out of the traditional 60-40 portfolio and the significantly higher, like 800 basis point higher investor expectation. So what are investors doing about this? Well, if we look towards institutional investors, they have addressed this potential issue. So if we look at the standard endowment portfolio, they're now allocating 52% of their assets to alternative investments. If we look at the standard retail allocation to alternative investments, it's only 5%. So there's this massive world difference between retail investor portfolios and more sophisticated institutional investor portfolios in terms of diversifying and allocating to alternative investments. So going over a brief overview of the alternative investment sector, like it's been growing double-digit rate, 10.6% annualized, is expected to continuously grow to exceed 20 trillion globally over the next few years. So they continue to attract investors and get significant inflows to alternative investments. And why is this happening? Well, one reason is if we look at a very brief overview of the history of asset allocation and how it evolves over time, because certainly asset allocation has evolved tremendously. So if we rewind to the real early days of asset allocation, I'm sure it wasn't even called this back then, but institutional investors, say 100 years ago or over 100 years ago, they would strictly only buy government bonds in terms of securities. So US Treasuries, and that would be it. Then they started to expand their horizons, move into real estate, mortgages, preferred shares, but they deemed common stocks far too speculative and, instruments for gamblers and speculators, not investors. Then we go to the period between 1920 and 1950. Institutional investors started adding corporate bonds, which was brand new at the time. They were previously deemed unfit for institutional portfolios. However, they did start to branch out, further diversify to corporate bonds, and they started buying equities as well. What was previously deemed too speculative, institutional investors started buying. And the whole point of this exercise is as institutions go, retail and advisor portfolios tend to follow. So as institutional caught on to equities, individuals went and followed. Then 1950 to 1980s, added average quality corporate bonds, international equities. Those were brand new. No one would invest outside of domestic markets, but certainly they started expanding their horizons prior to 1980. And 1980 to present, we really saw a boom in all sorts of different types of investable assets and a real proliferation of different asset allocation techniques. For example, junk bonds, small cap stocks, structured products, and a vast myriad of alternative investment strategies for institutional portfolios. And so it's really interesting how they evolved over time. And as I indicated, advisor portfolios and individual portfolios tend to follow with a bit of a lag what institutional investors do. And can you believe that at one point stocks were deemed too speculative and even institutions wouldn't own it? And now stocks are believed to be a core of a portfolio. So it really just shows you how things change over time. So be cognizant of that. Wanted to start talking a little bit about various alternative asset classes, the first being hedge funds. Now, hedge funds typically invest in liquid markets with the goal of outperforming a specific benchmark or maximizing Sharpe ratio. And by Sharpe ratio, I mean return per unit of risk. So it's not necessarily, to do better than the S&P 500. It's, say, a hedge fund could have a mandate, produce 8% annualized return with 6% annualized volatility with low correlation. That's just one example of what a hedge fund is looking to accomplish. And within the hedge fund space, there's a wide variety of various strategies, whether they be long-short equity, global macro, distressed debt, event-driven, arbitrage, etc. This asset class has a number of strategies within it that each provide, a different risk-reward profile. So it's really unfair to group hedge funds into one bucket. Some are risk reducers, some are risk enhancers, some are negatively correlated, some are positively correlated. So it's really important when considering hedge funds to really look under the hood to see exactly what the mandate is, exactly what it's looking to accomplish. So in this example here, we show two charts, and this is where hedge funds have come in handy in the characterization of mitigating risk. So if we look at two recent bear markets, for example, 2008 global financial crisis, 2008, 2009, the hedge fund index fell half as much as the composite equity index. So just showing some of that downside protection. Then in 2015, hedge funds were actually up when the market went into a correction. And here's a long-term analysis of a number of various hedge fund strategies where we look at return per unit of risk. And so strategies should always be judged on return per unit of risk because that's ultimately what's most important is Sharpe ratio. So this slide really gives a sense of historically where various hedge fund strategies have performed. And you can't just look at their comparison to global equities on a return only basis, because as you can see in this graph, global equities had substantially higher volatility than any of the hedge fund strategies here. In fact, nearly double the volatility of all of them. So we're really comparing Sharpe ratio or return per unit of risk in this scenario. And as you can see, over the long term, nearly every hedge fund strategy has outperformed global equities and global bonds on a risk-adjusted basis, aside from global macro, which has done relatively poorly over the 10-year measurement period in this specific example. But remember, not indicative of future results, so keep that in mind as well. Touching on illiquid alternatives. Now, illiquid alternatives, some examples are private equity and venture capital that are typically not marked to model. Sorry, not marked to market, they're typically marked to model. And so I'm always skeptical of that. Nothing like marking to market to keep investment managers honest. But what we see on the private side is many can play with the numbers to make sure the volatility and risk seems lower than what it is. So keep that in mind. However, if we look at how some of the most sophisticated investors on the street consider their private investments, they actually assume very high risk and volatility. For example, the Yale Endowment has an assumption for their private equity volatility of 23.6%, which is significantly higher than what they expect out of domestic equity. And out of their venture capital portfolio, they expect volatility of over double their public domestic equity portfolio. So keep that in mind. Just because they mark to model doesn't mean they're not risky or they are not volatile. However, with that tremendous risk has come historical performance. I mean, historically, private equity and venture capital asset classes have generated higher returns. However, with that has come significant risk and volatility. The other thing, touching on private equity returns, historically they've been generated by buying low EBITDA small cap companies. And with the proliferation and massive growth in private assets and the capital flooding into the private equity space, the so-called illiquidity premium that private equity used to earn is now flipped and turned into a private equity discount, such that private equity funds used to earn premium returns by buying illiquid companies at a discount to their public market trading valuation. However, given the attractiveness of the mark-to-model valuation that many institutional investors enjoy and desire, that relationship has flipped such that we expect private equity returns to be lower than private or public market returns, just given it appears that given the higher multiples paid in the private asset side, investors are really just paying for that lack of mark-to-market. Now, don't be fooled that this lack of mark-to-market does not mean that there's no volatility. They're just trying to keep investors oblivious to it. But enough of that. Let's talk about the endowment model. And so the endowment model of investing means diversifying to as many uncorrelated return streams as possible. It was pioneered by David Swenson at the Yale Endowment in the 1980s. So it's over 30 years old. And as we can see in this graph, the vast majority of the largest endowments out there are allocating a substantial portion of their portfolios to alternative investments. The larger the endowment, the more alternatives that they use. So it just goes to show you where the industry is heading. One of the reasons why, we've seen a 40-year decline in interest rates. So if you go back to the mid-90s, and the problem with that decline in interest rates is endowments and pensions have not had a comparable decline in return expectations. They still have their 7 to 8% annualized expected return that they need to generate for their constituents, really just to match their liabilities, right? If a pension needs to pay out all this money or endowment needs to support a university, and they never brought down the return assumption. So if we rewind back to 1995, earning that expected 7.5% return wasn't all that difficult. You could do it with a 100% bond portfolio and have very reasonable volatility of just 6%. So it was very easy back then. But as interest rates declined from high single digits to basically 1%, it got increasingly difficult to generate that 7.5% expected return. So by 2015, bonds were down to half the portfolio. And then we're allocating to private equity, real estate, all these different asset classes, equities, just to maintain that expected return, but increasing standard deviation by 50%. Then by 2015, 20 years later, the bond portfolio was almost 1/10, down to 1/10 of the overall asset allocation, just to maintain the same expected return. Investors nearly had to triple the risk that they're willing to take on. And that's why you've seen all these alternative asset classes really proliferate and spread, just because investors are really reaching for those returns and yield. One thing to keep in mind with alternatives is historically they've been high fee. You look at equities and fixed income, passive ETFs, you can get for as low as a handful of basis points, like 0.03%. On the equity side, and fixed income is like 0.1 to 0.2%. However, alternatives are typically 1.5% to 2% management fee, and they generally have a performance fee, also known as carry, which can be as high as 15 to 20% or even higher. So keep that in mind. But also keep that in mind in the context of returns. Here I have a slide from CalPERS, which is a big proponent of private equity. Now, if we look at a slide that they produce, private equity has generated returns for them of 12.3% annualized, which is about 50% higher than what they've earned from their public equity portfolio. So, I mean, that's phenomenal. Their constituents did very well with private equity. However, if we look at a pre-fee basis, private equity earned nearly 20%. So they're paying annual fees of 7% to their private equity managers. Contrast that to 0.04% for public equity. The level of fees in private equity is just a world apart from what they're paying in public. So keep that in mind. Should look at, yes, absolute fee levels, but also net of fee performance. Consider that as well and try to balance the two. So on that, I do want to talk about a new ETF that Accelerate launched today, Accelerate OneChoice Alternative Portfolio ETF, where the first time anyone's brought that Yale Endowment Alternative Allocation to everyday investors, where they can get access to that diversified alternatives portfolio solution in a one-stop shop OneChoice ETF. So the way that we run OneChoice is we allocate across 6 alternative asset classes, as shown in this pie graph, and 10 alternative uncorrelated strategies, really with the goal of diversifying investor portfolios. As I stated, diversification is the only free lunch in investing. We're seeing rock bottom interest rates, high equity volatility. Are you comfortable just owning 2 asset classes? Or would it make sense, instead of owning 2, to own 8? I mean, we are seeing investors transition from this traditional 60-40 equity bond portfolio to something more like a 50-30-20, where we have 50% equities, so equities remain core, 30% fixed income, and then a 20% diversified sleeve of alternative investment strategies. And that 20% is really Accelerate's wheelhouse. That niche is the sandbox that we're looking to play in. And that's really where OneChoice, this tool that we've created for investors to further diversify, that's really where OneChoice comes into play, providing additional diversification through access to 6 alternative asset classes, 10 alternative strategies in one ETF. Now, there's a reason we allocate to different alternative asset classes, whether it be as a market hedge, whether it be to generate yield, whether it be to generate capital appreciation, inflation protection, and alpha. So the goal of OneChoice is not to select the best strategies each year. The goal of OneChoice is risk management before it's too late. We're providing asset classes such that in different economic environments, we're confident that something will always be performing well to provide that ballast or support for investor portfolios. The thing is, if all the strategies do well in one year, that would actually be negative because it means they're all highly correlated. We put together this OneChoice portfolio after a lot of thought. It was modeled after the 30 to 40 year development of the Yale Endowment portfolio. We adapted that to ETFs, and it was a very thoughtful portfolio such that we're looking to provide as much diversification as possible through these various alternative asset classes and strategies. Here's a historical simulation of if an investor were to move from a 60-40 to a 50-30-20, where they have 50% global equities, 30% global bonds, and 20% the OneChoice portfolio solution ETF. As you can see, lower drawdowns resulting in better outcomes for investors. And here are the stats of that simulation. So ultimately, what OneChoice is, it's a tool to diversify portfolios, and it aims to reduce risk and improve portfolio risk-adjusted returns in a very simple, efficient, and low-fee manner. So one of the main drivers of the assets that we've included in the OneChoice portfolio is correlation. And as you can see, all the alternative strategies that we provided are, generally uncorrelated from each other. So that's one of the main drivers of what we're trying to provide. As I indicated, we're not looking to pick the best strategies for this month, this quarter, or this year. We're looking to provide a sensible, long-term diversified alternatives portfolio solution that contains a myriad of uncorrelated return streams that can reduce risk and provide adequate returns. So just to summarize, OneChoice, it is an alternatives portfolio solution for investors to further diversify beyond just stocks and bonds. Does carry a risk rating of low to medium, does pay a 1.5% quarterly distribution, and it's an ETF, so real simple to trade. The symbol is ONEC, 1C on the TSX, and the management fee is just 0.2%. So great low-cost way for investors to get access to alternative asset classes. So to conclude today's webinar, I hope you enjoyed the presentation on alternative investments. Really, our goal is to inform investors, educate them on how you can further diversify your portfolio, de-risk in a very perilous economic environment. A lot of volatility. We're really trying to mitigate that, provide uncorrelated returns that hopefully can result in better investment outcomes. And then on Accelerate OneChoice Alternative Portfolio ETF, the first diversified alternatives portfolio solution. Simple, real efficient, diversify your portfolio, one-click buy, sell, low cost, accessible, and liquid. And that's why we believe alternative investment strategies may be the ultimate portfolio diversifier. My contact info is at the end of the presentation. This will be up on our website, accelerateshares.com, for replay. Please forward along questions in the chat. Happy to take questions over the next half hour for as long as my voice will hold up. So thank you for joining us for the presentation today. If you could please, consider a question in the chat and I can address it. So from Bern, what kind of investments would you use for real estate exposure? Yeah, so more color on the OneChoice ETF, and it is a liquid product. It is a low-cost product. And so ultimately, we're using the underlying exposures are largely ETFs with a couple closed-end funds. So for real estate exposure, we use ETF, global real estate index ETFs from both BlackRock and BMO. So that provides the real estate exposure. We also have exposure to infrastructure through another ETF provider. That one is BMO as well, and Flex Shares, private credit. We're investing in leveraged loans through Blackstone's ETF and mortgages through both iShares and BMO there. And then on alternative currencies, we own gold through the Sprott Physical Gold Trust and Bitcoin through the Bitcoin Fund, risk parity through the RPAR risk parity ETF. We're allocating to arbitrage and long short equity through Accelerate Arbitrage Fund and the Accelerate Absolute Return Hedge Fund. So in terms of the Accelerate products, they're roughly 30% in the OneChoice portfolio and 70% third party. People ask, how can they buy if they're in the US? So we know that US investors can trade through Fidelity and Schwab Global. Those platforms allow access to all of Accelerate's ETFs. Another investor asking about underlying fund fees. So there's a top level fee at 1C of 0.2% management fee, and the underlying funds have their fees as well. Some are very low, some are in the higher range, but ultimately we believe the overall product will have a total MER, top level and bottom level of 1 to 1.25%. How does the fund put a daily value on the private equity portion or the mortgages, etc.? Well, as I indicated, the holdings are all liquid and trade as ETFs. So for the mortgages, we have the iShares MBS ETF and the BMO Canadian MBS Index ETF. So that provides exposure to both US mortgages and Canadian mortgages to provide yield just as your standard endowment portfolio would. So another question, already on your RBTF, how much overlap would 1C have? Was it 10%? Yes, the Accelerate Arbitrage Fund is approximately 10% of the current OneChoice allocation, so there is a bit of overlap there. So if you have any other questions, please put them in the chat. I believe I've answered all the questions thus far. So if there's no further questions, I thank you for your participation today. Feel free to reach out if you have any questions. We have a book a meeting on our website, accelerateshares.com, where you can book a meeting with me, a virtual call. If you missed it or want a replay of this, check the event section of our website. And hope you have a wonderful afternoon. And thank you for tuning in. Best of luck with your investing. Cheers, everybody.